Welcome to Tulane University's Burken Road Reports video series. My name is Andy Parsons, and I will be discussing the Burken Road Report's continuing coverage of Cal-Maine Foods Incorporated as of November 19, 2015. Our team of analysts includes Evan Doremus, Drew Townsend, as well as myself. In this video, we'll present an overview of the company, our investment thesis, an industry analysis, Cal-Maine's financial performance and risks, and our final valuation. Cal-Maine is the largest producer and distributor of shell eggs in the United States and is headquartered in Jackson, Mississippi. Fred R. Adams Jr. founded the company in 1957, and in 1996, Cal-Maine went public on the NASDAQ using the ticker symbol CALM. As the largest producer of shell eggs in the United States, Cal-Maine employs 2,872 people and operates in the southeastern, southwestern, midwestern, and mid-Atlantic regions of the U.S. Cal-Maine operates processing plants, farms, warehouses, feed mills, and offices in 15 states. The facilities include 38 processing facilities, 2 hatcheries, 3 breeding facilities, 4 wholesale distribution centers, 40 shell egg production facilities, 20 feed mills, and 27 pullet growing facilities. In fiscal 2015, the company sold roughly 1 billion dozens of shell eggs, representing 23% of the domestic market. Since 1989, Cal-Maine has acquired 18 companies and has built numerous processing facilities. As a result of this strategy, the company's total flock of layers, breeders, and pullets has grown from 33 million in May 2010 to 42.1 million as of May 2015. Our team gives Cal-Maine Foods a rating of market underperform with a 12-month target share price of $54. Cal-Maine has benefited greatly from the damaging avian influenza that began in April 2015 and affected most of the Midwestern United States. The industry lost about 13% of the national flock of laying hens, which had to be euthanized. This decrease in supply caused egg prices to skyrocket. Prices for generic shell eggs in July and August 2015 rose to $2.14 and $2.85 respectively, helping Cal-Maine's net sales to increase 70.9% quarter over quarter in the quarter ending August 29, 2015. Cal-Maine should continue to profit from elevated egg prices, which are expected to remain high for the next 12 to 18 months as the national flock of laying hens is replenished. Furthermore, efficient operations helped Cal-Maine reduce factory costs and hedge against volatile egg prices. The company produces approximately 78% of the total number of shell eggs it sells and processes its own feed inputs. Also, the shift towards specialty eggs should boost Cal-Maine's profit margins. Specialty eggs command a higher price due to their increased requirements associated with being cage-free and organic. Lastly, the recent demand trend for eggs is a good sign for Cal-Maine. In 2015, McDonald's, which bought over 4% of all eggs produced in the United States in 2014, announced it will offer an all-day breakfast, along with Burger King and Starbucks making similar announcements. Consumers are demanding more profitable, value-added eggs, which is an indication that the general public is moving away from processed foods that are substitutes for eggs. The shell egg industry remains highly fragmented, even though there's been a recent trend towards consolidation. The industry expects continued growth spurred by high-protein diet trends, fast food restaurant consumption, and reduced cholesterol levels in eggs. Demand for shell eggs averages a 1% growth per year in line with overall U.S. population growth. In 2014, egg consumption reached 263 eggs per person in the United States. Although the production of eggs in the U.S. is widespread, the top 5 egg-producing states, Iowa, Ohio, Indiana, Pennsylvania, and Texas, claim around 49% of the domestic egg-laying hens. The industry experienced a damaging avian influenza this past summer that mainly affected the Midwestern states. As a result, the total U.S. hen flock was reduced to 273 million, a drop of 23 million. Cal-Maine remains a strong financial performer. The company has posted growth in net sales every year since 2008 on strong growth in demand for eggs. The company's financial performance has been greatly improved by recent record egg prices. Based upon current projections from the USDA, we anticipate Cal-Maine's revenue per dozen eggs to drop 10% per quarter as egg prices normalize, as you can see in the graphic at the bottom of your screen. The company's major operating cost is chicken feed, which depends on the prices of corn and soy. The 2015 crop has been strong, and input costs are expected to remain favorable in the coming year. The company's share price closed at $55.60 today, up 30% from last year as a result of these favorable market conditions and strong operating performance. The company's gross and operating margins both exceeded historical averages in their first fiscal quarter of this year, as depicted by the leftmost pair of columns on the graph. As egg prices return to normal levels, we project the margins will return to historical averages in a linear fashion by the first fiscal quarter of next year, on the right-hand side of the graph. The performance of Cal-Maine Foods is affected by a number of risks. The company has no control over the sale price of its product, and its demand trends could move favorably or unfavorably driven by changing research and perception of eggs. Additionally, 50% of the company's revenue is concentrated amongst its top 5 customers, and any change in one of those relationships could have a material effect on the company's performance. Avian influenza and a variety of other diseases which affect chickens could threaten the company's flocks at any time, though significant biosecurity measures are taken to minimize this risk. The company's growth is dependent on the availability of attractive targets for acquisition, as well as compliance with antitrust laws. Furthermore, the company faces an ever-changing regulatory landscape and must comply with rules set forth by the USDA, FDA, and the EPA. Our team's valuation of Cal-Maine Foods relied upon a discounted free cash flow to the firm analysis, which yielded a 12-month target price of $54. The group found a weighted average cost of capital for the company of 11.58%, which assumed a 3% liquidity risk premium as a result of Cal-Maine's relatively small market capitalization. The tax rate for Cal-Maine is 37%. We found the company would reach a terminal growth rate of 2.8% in 2024, which is a combination of the growth rate of the U.S. population, which coincides with the growth rate of demand for eggs, as well as the inflation rate. We also considered 2 other valuation models in the process of finding a share price for Cal-Maine. The first was a price-to-book value target price of $66.19, and the second was a price-to-earnings ratio target price of $44.28. We found that the 2 of these converged upon our discounted free cash flow to the firm valuation and simply reaffirmed our target price of $54. This concludes our continuing coverage report on Cal-Maine Foods Incorporated. Thank you for watching. For the full written report, please visit www.birkenroad.org/reports.php. The Birkenroad Reports are produced solely as a part of an educational program of Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not and may not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.